Yo, I'm Brendan, and today I've got an interesting one for you because M1 Finance allows you to get out of something really easily that I think most of us need to get out of. It's called stock lending. And today I'll share with you the problems with it and why they should really make more of a big deal about the fact that we're all opted into stock lending by default. I think once you learn about it today, you'll realize you don't want to be opted into it, and so you'll be able to get out of it really easily just like I did. So first off, what is stock lending and why is M1 Finance doing it? Stock lending is something that M1 Finance or any other brokerage cares about, but we as investors typically don't care about at all. It's not really something that facilitates what most of us are trying to do. It's really just something that helps the brokerage do what their business is. So think of it this way. Whenever somebody's traveling for a vacation or for an event or whatever, they might temporarily rent a house at like an Airbnb or a VRBO. They're jumping in there for a short amount of time, they're paying a premium to rent the place, and then they're out of there. Whenever we by default opt into something like stock lending, we are putting our stocks out there like these rental properties. We're saying, hey, you can rent out our stocks to do whatever you need to do with them, and we will collect that rent back from you. Most times we're just opted in by default, or if there is any information on a brokerage like a Robinhood or an M1 Finance, it doesn't explicitly say what all the pros and cons are about this. And at first it sounds like a lot of pros. It sounds like something you'd want to do. Okay, well, can I collect rent from my stocks? Like, why would I not want to do that? Well, turns out there's 3 or 4 reasons to not want to do that. The main selling point for stock lending is that you could potentially make money from doing it. Because whenever M1 Finance says, hey guys, we're going to take the stocks that you own and we're going to lend them out to somebody else, we will actually pay you some of the fee that we get for doing that. M1 Finance is like Airbnb.com. And so they get the money and then they give you a portion of it. But unlike Airbnb that only takes a small fraction of the overall fee that somebody pays, M1 Finance keeps 90% of the profit that they get from doing this, and they only give us 10%. So even if there were no other caveats, we're not going to make a ton of money from doing this. We're only getting a tiny little chunk of it anyway. But there are a bunch of caveats. And the first of those is potential tax liability. The crazy thing is that whenever that stock is loaned out to somebody else, the title and ownership of the stock are also transferred to the person who borrows it. So that means that all the benefits that you got from owning the stock are now theirs. They're not yours anymore. It'd be like if when someone comes to rent your Airbnb, now they own the house. That's crazy, isn't it? Isn't that nuts? And one side effect of that is that whenever you're owed a dividend for owning that stock, you don't get paid the dividend anymore. Dividends are really cool, A, because it's cash that you get, but also because you get better tax treatment typically on qualified dividends than you would on ordinary income from your job. So because now they are the owner of that stock temporarily, you don't get the dividend, you get cash in lieu of dividends. You get a little cash treatment. And so it's the same amount of money that the dividend was. You don't lose out on the money, you just get it in a way that's taxed less favorably for you. You essentially get taxed more on this money. Where was that in an outright disclosure? M1 Finance or Robinhood or whoever's doing stock lending. I want to know that up front. I wasn't told that. But wait, there's more negatives. Whenever you lend out your stock, you also lose your stockholder voting rights. Remember, all the rights you had from owning that thing are now to the borrower. And so I know most of us don't care about voting rights. Like, we're not voting on what companies are doing and stuff like that. But potentially, you could throw around the fact that you have ownership and you could help make decisions in the company. And so you're giving that up. But this next thing we lose is actually a big deal. I'm not sure about the voting right thing. I don't really care that much about that technically. But this next thing is totally shocking to me. I almost can't believe this is true. And the fact that they're doing this to us is really, I don't know, dangerous, it's brash, it's something that I'm not okay with, and I want to go through and remove stock lending from all my different accounts now. Whenever your stocks are loaned out to somebody else, you lose SIPC insurance coverage. And if you don't know what SIPC insurance coverage is, it's insurance from the federal government that protects you in case that brokerage goes out of business. So let's say your stocks are loaned out to borrower Michael in Wall Street somewhere, and they're doing their thing. And in the meantime, M1 Finance goes out of business. Whoops. Well, if they weren't loaned out to borrower Michael, SIPC insurance would have protected you in the case that M1 Finance went out of business. They would have said, hey, up to this amount, which I think is $250,000 per person, we're actually going to compensate for you for that so that you can have the value of the thing that you lost. Well, because they're lent out, you don't get that insurance. You don't get that coverage. This is mind-blowing. How can they do this? This is ridiculous. Now, that risk that you're giving up now because you don't have that insurance is supposed to be mitigated because the person who's borrowing, that firm that's borrowing the stocks from you, is supposed to set aside capital that's equal to the amount that they're borrowing from you. And so let's say M1 Finance goes out of business, then that person who borrowed is supposed to give you the cash. Now, if they both go out of business, then you're really screwed. But in theory, they've mitigated that risk. In reality, they really haven't, because there's more to that story. There's more risk and more exposure to us, the innocent retail investor, than anybody wants to talk about. Let's say that very thing happens. You've loaned out $10,000 worth of stock to Michael in Wall Street, and then M1 Finance goes out of business. Well, Michael goes, well, we had this cash that was set aside to protect you because you don't have SIPC insurance anymore. So here's 10 grand. You say, okay, great. Now it's 10 grand. But the tricky thing is that in between the time that you started lending him the stocks and now, what if the value of that stock went up? Now you have lost that stock. It is not yours. So you're stuck with 10 grand in cash and you've got to buy back your stock now at a higher price. That means you've missed out on all of that upward movement in the stock. That means all of those gains that have happened since you loaned it out until now, you've missed out on. They're gone. You're just stuck buying back the same exact thing at a higher price. You have missed your capital appreciation. This is just bonkers. This is nuts. Who would do this? Knowing what we know, who would honestly opt into this, especially with M1 Finance that only gives you 10% of the fee? Like, it would be one thing if I got 100% of the fee and I went, oh wow, not only am I getting my normal dividend, but I'm getting an extra, whatever it is, 5 or 10% per year on top of that. Well, then I could do that math myself and say, the tax burden I'm getting from my dividend turning into cash, that kind of sucks. The risk kind of sucks. Missing out on the potential gain if something bad happens in M1 Finance, all that kind of sucks. But in the meantime, I'm getting 10% extra per year. So I'm in it. I'm doing this. If it was a sweet deal like that, I could see opting into it. Even if it was a transparent deal and I could actually see the numbers and do the math, then I could see potentially opting into it. I somehow doubt it's going to pencil out for us because it's only 10% of the fee that we get. And this is just one of many tricky things that you learn whenever you dive deeper into the world of finance and investing and really anything. There's so much more nuance and nooks and crannies for people to benefit off of the regular guy than it seems like initially. Thankfully, it's really not hard to opt out of this, at least when it comes to M1 Finance and Robinhood. Like in Robinhood, whenever you open up your settings, you can literally just opt out. So whenever you're in your settings screen here, I'll screenshot this for you, put it up for you. You can see my stock lending is disabled. And all they say is the positive. With stock lending, get the opportunity to earn extra income on your portfolio. Okay, looks like Robinhood's standard is 15% of that little bonus they get for loaning the stock out. So that was pretty clear and obvious. With M1 Finance, it's a little bit more work than that, but it's not too hard. So I'll link this page for you right below the like button in the description so you can find it. It's the section on M1 Finance's like support page on fully paid securities lending. They tell you about the 10% revenue you earn. They tell you about the dividends that you're missing out on. And then it says to unenroll in securities lending, send an email to M1 at help@m1.com. And you have to put securities lending opt-out as the subject line. And so I wrote a simple email to them. I didn't put an account number in or anything. I just had my name in there. I sent it from the email that was linked to my M1 account so they could kind of do that linking themselves. And I just said, please unenroll me from securities lending. 2 days later, they said, okay, great, you're unenrolled. Thankfully, it was pretty simple and painless. And so now I don't have that exposure. I'm not going to have the crappy tax treatment. I'm not going to have the potential for appreciation loss. But I think the overall mood I have about this is just disappointment. How can these companies be about us if they're not making these kinds of things obvious to us? I mean, they're clearly profiting enough from it that it justifies them keeping it fairly under wraps. It's not going to benefit them to come out and be open about this kind of thing because they're going to lose money. Well, they're not going to lose money. They're just going to lose the potential for profit. It's an opportunity cost thing for them. But since I don't work for these companies, and I work for you, I wanted to make you aware of it so you can make an educated decision for yourself. Do I think objectively, if we zoom out to 10,000 feet, that you being enrolled in fully paid securities lending is going to completely harpoon your gains? Do I think it's going to ruin all of your investments for the rest of your life? Probably not. It's probably not going to be a problem, but it could mess stuff up for you. And it is added exposure that I don't think we're fairly compensated for. So in my mind, until we're compensated adequately for it, opt me out. Get me out of here. If you want to see another video about M1 Finance and their latest update, which people are really strongly for or against, as it turns out, because if you've got more than $10,000 in your account, you probably love it. If you've got less than $10,000 in your account, you probably hate it. And you can watch that video next right here. Thanks. I'll see you later. Bye.